Here you go. Why is dollar yen chart on the upward trend? So this is because we are in the trend of momentum that people sell yen with low yield rates and buy and manage the US dollars with high yield rates in the exchange market. So people expect others to sell yen and buy and manage US dollars. So people's feeling of expectation that yen dollar chart should be on the upper trend causes yen dollar chart to be on the upper trend. So currently dollar yen chart is on the upper trend if we see it based on the US dollars. And conversely, a dollar yen chart is on a lower, extremely lower trend if we see it based on the Japanese yen. So currently, corporate investors put on yen carry trade. So yen carry trade is an exchange trade to get a profit margin of the interest rates, in addition to management gains by managing currency and other financial products of a country with high yield rates after borrowing yen with low yield rate from a financial institution. For example, you borrow 100 billion yen from a financial institution and you buy dollars with 100 billion yen. And you sell yen and you buy yen repeatedly. You just trade in the exchange market and you also manage the US government bonds with remaining dollars you have. So when we invest in the US government bonds, we have a long-term interest rate in the US government bonds. So a long-term interest rates of US government bonds basically indicates 10-year US government bonds. So yield rates of 10-year US government bond now is about 4%. This much is a little bit higher than federal fund rates, which is like 3.25% as the cap interest rate, right? So it is pretty rare that 10-year US government bond goes on to 4% over the past decades. And basically, we lend money to the US government, United States government through the US government bonds, right? So credit of the United States government is basically very high and stable on the premise that this country doesn't default, right? So yield rate that you can get by managing the US government bond is called risk-free rate. So basically the US government bonds are generally seen that there is no risk on investment of the US government bonds. But principally, the government bonds issued by any countries have a certain risk, like a country defaults principally, right? So however, the probability the US government defaults is realistically way lower than the probability that private companies go into bankruptcy, so that the US government bonds are assumed to have no risk on it. Right, so you can manage the US government bonds with risk-free, and you can get 4% return from it stably, right? So in other words, stock trading that falls below 4% yield rate is not really good, basically. So in short, you just firstly fundraise yen from a financial institution and change it into dollars. You buy US dollars with yen and manage US dollars with US government bonds. And for example, you manage the US government bonds with 4% yield rates, and yen borrowing interest rate is 1% to 2%. In this case, you can earn profit margin between the US government bond yield rates and Japanese yen borrowing interest, 2%, right? So you borrow yen with 2% borrowing interest rates from a financial institution, and you manage the US government bonds with 4%. So actually there is a currency exchange loss in profit margin because of fluctuated exchange rate between two currencies. This is a system of yen carry trade. So corporate investors primarily take advantage of this system to gain profit margin from the difference of interest rate between Japanese yen and US dollars.